Hi, this is KareyBrown with EXP Realty, and this is Real Estate 101. And I'm back with Kim Penrod with Fairway Mortgage. Hi, Kim.
Hello, hello.
So, conventional loans, this should be an easy one. Uh,
Yes,
least amount of requirements next to that.
yes.
Uh,
And it's great when someone has 20% to
absolutely.
put down.
Now, there are different down payments. You can do a 3%, a 5%, which we've covered
Yep.
in. When did we cover that one in?
So conventional loan, yes, you can do anywhere from 3% the minimum all the way up to whatever you want. Pretty much you can do 50% down if you wanted. But 3% is the only one that has a requirement that you cannot have owned a home in the last 3 years. So if you owned a home 5 years ago and you've been renting for 5 years, you qualify as a what they call first-time home buyer, and you can put 3% down and do a conventional loan, which is really great. It used to only be FHA had the 3.5% down, and conventional was 5% down. With conventional, though, now you can do 3% down. The one thing that we're going to require you to do when you're doing 3% down is to take a online course. And it's really simple. You just need to mark out a couple hours one evening and log in, and you'll take the course. And it's really just educating you on homeownership. And then you'll save that certificate and email it to me, and I'll add it to your loan file. And then that will show that you've met the requirements. You've not owned a home in the last 3 years. You took your home buyer's course, and now we can move on with the 3% down. I typically, when someone applies for a loan, I don't have them do that class until after they've gone under contract. And the reason I do that is because at one time the class cost $75, which they can pay with a credit card. But I didn't want them to pay the fee if they ended up not buying a house.
Right.
Now we have one that you can take that is totally free. It doesn't cost anything. So I can give that website out sooner. That just started this year. I can give that website out sooner and tell them, hey, if you want to get this knocked out on your own time, then go ahead and take it, keep the certificate. And then when we do go under contract, you can send that certificate to me to show that you've already done it. Whereas if we do it when the contract goes into place, I usually give them a deadline and say, okay, you have to have this to me in 10 days. And for the most part, that works out okay. But some people are really busy with work and kids and life, and taking 2 hours out of their evening to sit down and take a class isn't always a lot of fun. But back to conventional, if you put you can do 5% down, you can do 10% down, all the way down to 20% down, you're going to have PMI. And PMI is that private mortgage insurance that you have to pay every month to the lender. It only benefits the lender. It does not benefit you in any way. It's not an insurance for death or anything like that. It's just totally covering the mortgage. But any down payment of 20%, under 20%, you're going to have to pay that PMI. Now, the PMI does drop every percent. So it's in 5% increments. So at 5%, your PMI is going to be, let's just say it's $100. If you put 10% down, that PMI might drop to $80 a month. If you put 15% down, it might drop to $50 a month. And the reason I can't give you an exact amount is because it's based on credit score. So the higher your credit score, the more you put down, of course, the smaller your PMIs, the factor will be. That will be the least expensive PMI. If your credit score is, you can do a conventional loan down to 640. What is going to be expensive is the PMI at 640. If you're putting 5% down at a 640 credit score, your PMI is going to be really high. In that situation, we would want to consider doing FHA because the PMI would be less. I mean, it could be 3 times as much. It's just crazy how much more expensive it could be at a 640 credit score. But if you're doing 640 and you're putting down 10%, it might be better to do conventional versus FHA. But at least you have that option that you can do conventional if your credit score is not as high. You just have to have some money to be able to put down. The other thing on conventional with down payment, if you're asking a seller to pay cost, they can only pay up to 3% of your cost if you put down 3% or 5%. So the seller pays can go up with the increase in down payment. So if you put 10% down, I think it's at 10%, it jumps to 6% the seller can pay. So it's, yeah, you can get more benefit from the seller if you're putting more down, in other words. So again, putting more down on conventional is always great, but not everybody has more than 3% or 5% to put down. And you can still do a conventional loan. And the main reason people would rather do conventional versus FHA on the buyer side, the biggest benefit is that PMI, because it will go away once you have 20% in equity. You would call the lender and you would tell them, hey, I've paid down my principal to 20%, where I have 20% in equity now, and I want to have that PMI removed. Most likely the lender is going to require that you have a new appraisal done, and then they'll remove it. They just take it off. You do not have to refinance. You don't have to pay any fees other than an appraisal fee, and that's about $500. There are times where you won't have to have an appraisal done. It will depend on how long you've been there and kind of what factors, like they will look at increases in values over the history of the home. So if you've been there 10 years, they're probably not going to question that you've got 20% equity. Right. But if you've only been there 2 years, they're probably going to question that you've got 20% equity, and they'll want you to do a new appraisal. With conventional, there's no prepayment penalty. You can pay down early at any time. So we always recommend, if you have PMI, put as much toward your principal as you can each month to build that equity. The sooner you can get that equity built to 20%, the sooner you can get rid of your PMI. And then that's that much more money you could apply to your principal once it is removed. And remember, our goal is to build that equity, because that's our retirement. That's our nest egg for the next house. If you're going to sell it, you'll have more equity in the home to put down on the next home. I was thinking about
20%, just for clarity. So if someone's watching this and they think, okay, well, Kim can give 3% conventional for an investment property, you need to be clear that 20% is conventional for an investment property.
Right, you're exactly right. Owner occupied. So you have to live in this house in order to put 3%, 5%, 10%, anything less than 20% down. Now, if you're buying an investment property, let's say you're buying a house and you want to rent it and become a landlord, then you'd have to put 20% down. There's no way around anything less on an investment property. Also, one thing we've not talked about, Karey, is second homes. We can do second homes. Now, let's say we have a buyer that's in California and they're wanting to buy their second home here in Kansas. They can do a second home and put 5% down. They don't have to put 20% down. I've also done a situation where I've had a parent buy their college child a home. Let's say they're going to Washburn University and they wanted to buy a little rental house for the child to live in. They can call that their second home and only have to put 5% down.
So do they have to verify in some way that that's really a second home and not a rental property?
What they would do is just write a letter that their child's going to Washburn and is going to live in this home, and they are going to stay in this home when they're here visiting them. Basically, they could say they're going to come, you don't even have to put a time frame on it. You would just say it's going to be your second home and your child's going to live in it while they go to school. I did one about a year and a half ago, and it was slick. If I'd have known that, I think when my kid, of course, I live in the same state. If you live in the same state, that's not probably going to work.
Gotcha.
The parent lived in another state. And so for them to, if they lived, like if I bought a second home in Manhattan, Kansas, the underwriter's not going to buy that because I live here in Topeka.
Right.
So it's got to be believable. Yeah, that parent would definitely have to live in another state, and then they can show that I'm not going to buy a house 30 minutes away and call it my second home.
That makes sense. And
Yes.
That's awesome.
Yes, it is awesome. So I think, what other questions can you think of that I missed?
I think you covered it all.
Okay.
So if you're interested in a conventional loan, how do you get a hold of you?
You can call me anytime on my cell phone. That number is 785-640-1700. I can take an application from you over the phone. And then if you'd rather fill out an application online, I do have a website. So just give me a call and I can give you that information, or you can text me and I can give it to you as well.
And our number for my team is 785-213-5188. Thanks for joining us on Real Estate 101.
Thank you.